What's up, guys? It's Rowan and Terry here from ArtofSmartTV, and we're bringing you the next episode of the HSC Economics review. Now, in this episode, we're going to be diving in to look at the state of the Australian labour market. In particular, we're going to be looking at wage growth. It's been a bit of an issue lately, and we're going to talk about the new NAIRU. Yes, that's right, we have a new NAIRU. Now, why is this important? Well, I think, the RBA not too long ago cut the cash rate to a historical low, right, 1.25%. And in doing so, the governor announced of the RBA that, one of their main issues was, low income growth, right? So clearly what's going on here is there's some major issues occurring for the Australian labour market that we need to unpack. And that's exactly what we're going to be doing in this episode. We're going to be exploring wage growth in Australia. We're going to be looking at why we have slow wage growth, what the implications are of it. And in particular, this is going to be really relevant for you in your essays when you're having to analyse effectiveness of policy, particularly analysing the effectiveness of monetary policy and whether or not it's going to have an impact. We're going to need to consider the extent to which it's going to really shift this wage growth issue and therefore have, the outcomes it's intending to have on the economy. So to kick things off, I suppose an initial question, Terry, why is wage growth even important for the Australian economy?
Well, hopefully we all understand that wages are important because it's what we earn as households, right? And the spending that we have is directly influenced by how much we earn. So aggregate demand, as you've been learning with fiscal policy and monetary policy as part of macro policy, is influenced by 60% of it is actually influenced by consumption, right? Consumption from households, and then therefore if that's consumption by households, then it matters how much they're earning. Next couple of things with this is then if AD is low because of low wage growth, you're also going to get some very poor inflation outcomes. Now, if you remember with monetary policy, the goal of inflation isn't to have inflation too low. There's a range between 2 to 3%. And so if it is a little too low, that can also have issues as well.
So in other words, just to contextualize, if consumption is the biggest driver of aggregate demand and wages are the biggest driver of consumption, we've sort of got to sort out wages to be able to then get inflation kicking, economic growth kicking. It's like this really important lever or cog in the economy that we need to work on to get it to work. So I suppose that the next question now is, what's our wage growth like?
Okay, so actually, wage growth has actually been a little bit better in recent times. Okay, so over the past 3 years, wage growth has been particularly poor. It's actually started to pick up a little bit. It's at 2.3% at the moment. And it hit a record low of 1.9% in 2017. So it's actually not doing as bad as it used to. However, if we zoom out a little bit more, right, wage growth in the recent times has been very, very different from what it used to be. So what was it like maybe 10, 20 years ago? Yeah,
so look, if we look at the long-term trend and we zoom out to sort of 1998 to sort of 2019, okay, the average wage growth was sort of around 3.2%. That's average, right? So there were times where it was, of course, considerably higher. So we can see that, when we hit the 1.9% in 2017, that was well below the average, and even 2.3, which we're saying is an improvement, it's a stronger recent trend, that's still almost 1% below the average wage growth we've seen, over the last sort of 20 plus years. So I guess it raises, this concern, I suppose, about, our wage growth isn't going the right way. And really, it hasn't since the GFC. We've really seen it trend downwards since GFC, and depending on how you look to measure it, it could even be considered even worse, because if we look at another way that you can measure wage growth is average weekly earnings. So you look at the growth in average weekly earnings, and what's really interesting here is that the average there is about 4%, but we've seen growth only of about 2% in average weekly earnings, and so some economists have gone as far to say that this is the worst wage growth statistics since the Great Depression or Second World War, which is, I guess, the reason for concern for the Australian economy, even if, we're saying that it's improved a little over the last sort of couple of years. So why is this a concern for Australia? What's happening macroeconomically that is saying, yes, our wage growth is a problem?
So as we were able to, as Rowan established, right, there's a really clear link between wages and consumption and therefore aggregate demand, right? And so based on the level of expenditure in the economy, right, that's going to determine our level of economic growth. Okay, and so there's a very clear link here. Wage growth has been really poor, and hopefully you're aware as well, economic growth has also been really, really poor. So that's a very clear relationship between the two. We've got economic growth currently sitting at 1.8%. We've got forecasts in the budget that say it should be about 2.25% for the year and continue to go up, right? But if wages aren't going to pick up, then this would present a severe challenge to actually reach that economic growth goal. Mm-hmm. The other side of the story is, of course, the short-run Phillips curve. Okay, so when you've got very, very low rates of wage growth and therefore inflation, that also generally implies that you're also going to have a very high unemployment rate.
Or at least a growing unemployment rate, definitely. Yeah. So I think what has then caused that, right? You know, I mean, like, why are we in this sticky situation? Like we did mention post-GFC that it's been trending downwards. Clearly the macro conditions are not pointing in the right direction. What are some of the factors that are contributing to this low wage growth?
My biggest factor that I like to look at is actually just the casualisation of the workforce. Okay, because I believe that since the 1980s, we used to have unemployment up in the 10% range, right? Above 10%. It's gone down a lot since then, and I think there's a lot of advantages with that. But I think just recently we're kind of starting to see some of the disadvantages of that. When you have labour market reforms, you make it more flexible, you make it easier to hire people. One of the downsides of that is, well, simply you leave a lot of underutilised labour resources, right? Because if you're dropping that unemployment rate, people are generally finding jobs, but at the same time, they're not finding full-time jobs. They're finding casual jobs instead. Think about a casual worker. They're probably going to be less able to bargain for higher wages compared to someone who's full-time. So that's my biggest reason. What about yours?
Yeah, and I think before I share, one of my biggest reasons, I think just to note and to really explicitly connect this for you to the HSC syllabus and course, right? What Terry was just exploring was really one of the limitations of some of the microeconomic reforms that we've seen, particularly around the labour market. So we've seen a move to a more decentralised model of wage determination. That's had a lot of positives, certainly, but clearly one of the implications here is perhaps that it's also now placed significant downward pressure on wages. One of the things we used to see in the 70s and 80s was wage breakouts, and that was one of the biggest fears of the RBA and the government from an inflationary perspective, because if wages go up, inflation's going to go up very quickly. We've shown that connection, right? So I think certainly casualisation has played a role, and it's a result of these labour market reforms. So if you're getting a micro reform essay, it's an opportunity to actually bring some analysis around wage growth and the issues it might now be creating for the Australian economy. I think just to build on Terry's point, for me, for one of the major current causes, because Terry's, I think, example is looking at sort of the structural change that's resulted in the economy over the last 20 to 30 years. I think a more immediate cause is this idea, which the RBA has talked a lot about, and you're going to hear it and it's going to sound like jargon, so we're going to try to explain it for you. And that's the phrase spare capacity in the labour market. Okay, it's thrown around a lot, and essentially all it's referring to is a couple of things. Like one, unemployment. Okay, so if you're unemployed, you've got time that you could be using and resource towards being employed and producing something. So there's spare capacity there. But it's not just unemployed, it's the underemployed, as Terry highlighted, so those that are casualised, that are working 10 hours a week but want 40. And the combination of those two, okay, the unemployed and the underemployed, form what is known as our labour underutilisation rate. And if we do look at that, we've seen that's growing, that's at 13.7%. So it's considerably higher than the 5.2% unemployment rate that we've seen. So right now, simple idea, if you've got more capacity in the economy, you've got every employer who puts a job out, if they know that 10 people are going to turn up to apply for that job, as opposed to 2, they're going to get to choose who they hire. And so as a result, there's not going to be that much upward pressure on wages. They're going to be able to offer lower wages, knowing that if the first 8 don't say yes, the last 2 might. So the greater capacity you have, the lower the pressure is for wage growth. And so right now, the RBA believes that we've got, due to this casualisation, due to the unemployment figures underestimating the true issue of labour utilisation, we have a situation where there's low wage growth because we've got lots of people that actually are still looking for work and could be working more. So I think right now that's also a key issue. And really, I think we can say that it's really been an issue since GFC. GFC really prompted an increasing casualisation as firms needed to shed workers, and or shed the nature from part-time and full-time to casual. So I think that's a really big issue, and it's one that the RBA is particularly focused on right now because it's a short-term macroeconomic issue that they can solve. Yeah. The changes microeconomic is something that the government itself needs to sort out, but the RBA itself, their only option is to deal with the macroeconomic side of things. I think what's interesting is that as part of this, they have changed the NAIRU now. I mean, what's the new NAIRU? What's the thinking behind changing it?
So the new NAIRU is at 4.5% unemployment rate. So that means that originally they used to think it was around 5%, which meant that once unemployment hit 5%, they'd expect inflationary pressures to pick up. Now, obviously, unemployment did hover around 5% for much of last year, and they actually didn't see a pickup in inflation. So economists, they kind of looked at that and they said, hang on, well, that doesn't make sense. So we need to go back, recalculate our data, do some more models, and what they've arrived at is 4.5%.
So, and then it shows really if the NAIRU is at that point, we do certainly have that spare capacity that they've been talking about. So that's two major issues. I think there is a third issue here that is also contributing particularly, and that's labour productivity. What's our labour productivity like? How does that relate to wage growth in Australia?
Okay, so labour productivity basically just refers to the amount of output that each unit of labour input is able to generate. So obviously, the higher your labour productivity, generally speaking, because of the way that we have enterprise agreements, you're able to then go to your boss, bargain for higher wages by saying, look at me, I'm being more productive, I'm more worthwhile to your company, give me a pay rise.
And that's important because and this goes to Terry's earlier point about the labour market changes in terms of regulation. The shift in microreform was to connect wage determination more closely to productivity. That's a good thing. It's a good thing because it reduces inflationary pressures, right? If you're being more productive and you ask for a pay rise, it's not going to create cost push inflation because even if you're getting a pay rise, the cost per good or service that you're creating should stay fairly similar because you've increased your output. Clearly, though, what that creates, though, for Australia right now is a fairly low labour productivity over the last decade and beyond, and so wages track pretty closely with labour productivity. So, I mean, what we're sort of looking at, a fall in labour productivity year on year of about 0.5%, a little bit over 0.5%. So, labour productivity's going backwards. Yeah. Which is not great. So it sort of explains low wage growth, I think, as well. Any other major reasons why we've got slow wage growth? Anything else that...
I wanted to add another one just on the GFC point that Rowan had earlier. After the GFC hit, I think it really did affect businesses and their confidence in hiring employees. And it's also just important to remember that in Australia, we typically actually do have quite high labour costs compared to some other countries. And so part of the reason why it's so high is just because of things called on-costs. Okay, so on-costs can often go up to about 30% of the actual wages paid to an employee. So these are just things like your annual leave, your other leave entitlements, sick leave, things like that, and superannuation, of course. So it actually does give an incentive, I believe, for businesses to actually casualize their workforce, right? So because if they have one full-time job and they can split it up into a bunch of part-time jobs, that reduces significantly the amount of on-costs that they have to pay. Because if you remember, with superannuation, you don't actually have to pay it until you reach $450
a month.
Yeah, there we go.
That's right. If you split it up, you can get creative, definitely. So I think what's interesting about all of this is, well, what are the implications? So we've identified why wage growth is important. What the current state of wage growth is in Australia, not great. What are the driving causes, both structural and long-term and macro, economic and short-term, that are contributing to slow wage growth? What's the impact? What's it gonna do for the Australian economy?
Well, obviously, as we've said, it's going to slow down the Australian economy. I think there's going to have a lot of implications on policy, which we've already actually seen with the RBA dropping the cash rate to 1.25%, a historic low in June. And I think that's the response here is to try and get wages picking up again, to get labour, to get the unemployment rate down again, to actually just reduce some of that excess capacity.
So in other words, what we're sort of seeing is really an idea that unless wage growth can increase, a little, we're not going to see many of our other objectives being met. We're not going to see economic growth really increase. We're not going to see unemployment. Well, there's a strong relationship with unemployment, which I'll unpack, but we're not going to certainly see inflation increase. So we're going to see a pretty soft macroeconomic set of conditions for Australia. Now, I think the interesting thing here is that the RBA has identified that they don't see wage growth really ticking up until unemployment gets closer to 4.5%, which is their NAIRU, right? Because that's going to tighten the capacity and drive some wage growth. And so it does go to show that, I think, one, we're probably going to see ongoing more aggressive monetary policy over the next year because, how do they get unemployment down from 5.2 to 4.5? They're going to have to be continually expansionary. We have seen some other things though. I mean, we've seen some changes by the Fair Work Commission. What have they done to try to support wage growth?
So the Fair Work Commission, if you're not familiar, they set actually the national minimum wage. So every year they will meet with unions, they'll meet with employer associations, and basically they'll come together and make a decision on how much they should or if they should increase the minimum wage. Now, oftentimes, of course, we've got inflation, so usually they will at least increase the minimum wage by at least inflation. This year, they actually agreed to increase the minimum wage by 3%. So the hourly wage went up to $19.49. And this is, of course, going to support that low wage growth simply because it's literally driving up the minimum wage. However, it is important to mention that this 3% is obviously going to be higher than the wage growth in other for other kind of wage determination agreements.
Yeah, definitely. And so we do the maths, 3% increase on awards, inflation's 1.3, so there's a 1.7% sort of lift. Note that, the average in the market though has been 2.3 anyway. So it is a little bit lower if we're looking at the real wage growth here, which is the difference, right? But I think it does show that overall the real wage growth will be more significant, which is interesting. I think the final thing, I suppose, just as we're sort of wrapping up here, is to also consider the budget's role. Okay, so the budget is also trying to support this, arguably with the tax cuts. Yeah. Okay, so they're trying to increase disposable incomes. The $1,080 for low to middle income tax offsets that are going to be provided. Although the question is, to what extent will this actually be passed on? So the Australian Council of Social Services has argued that the actual dollar impact to a low to middle income earner is about $10. So it's questionable, right? We've got the government saying $1,000, give or take, is going to be there to increase disposable income, and we've got other analysts saying, well, the actual reality is going to be a lot less. So the hope here is that we see sort of this trifold approach. We've got monetary policy, lower cash rate, we've got micro-reform through, the Fair Work Commission's changes in the award minimum wage, and then we've got fiscal policies approach through tax cuts to increase disposable income. And the hope is going to be that the three of those things is going to do enough to lift wage growth. So my question for you, our question for you really is, do you think it will, right? I mean, this is an opinion that you need to have. You need to have an opinion because you will be analysing the effectiveness of all of these three policies in achieving the objectives. And given that wage growth is this key lever, you're going to need to have an opinion on, will these policies be enough to increase wage growth in Australia and therefore support Australia achieving the economic growth, inflation, unemployment objectives that the RBA and the government has set. So let us know, do you think these policies will be sufficient to lift wage growth? Pop it in the comments below. We'd love to hear what your thoughts are. Additionally, if you have any questions for Terry or I, leave them in the comments. And otherwise, we will see you in the next episode.
Okay.